Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Core Natural Resources Inc. Annual Report. Core Natural Resources Inc. offers a diverse range of businesses and services through its various segments. The company's primary focus is on coal production, with operations spanning across the United States and internationally. Its high CV thermal segment produces thermal coals from mines located in Pennsylvania and Colorado. The metallurgical segment, on the other hand, specializes in producing metallurgical coals for use in steel production. This segment operates several mines in West Virginia, including Lear, Lear South, Beckley, Mountain Laurel, and Itman coal mines. The Powder River Basin (PRB) segment is responsible for surface mining operations in Wyoming, with two major complexes, Black Thunder and Coal Creek. In addition to its coal mining operations, Core Natural Resources, Inc. also provides terminal services through its Core Marine Terminal segment. This segment operates a coal export terminal in the Port of Baltimore, facilitating the transportation of coal to international markets. Overall, the company's business portfolio is centered around coal production and logistics, with a strong presence in both domestic and international markets. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause an increase in stock price for Core Natural Resources, Inc. The stock price of any company, including Core Natural Resources, Inc., is influenced by various market and economic factors. One key factor that contributes to an increase in stock price is positive earnings growth. When a company reports higher than expected profits, investors become more confident in its ability to generate revenue, leading to increased demand for the company's shares. Another significant factor that can drive up stock prices is industry trends and market conditions. If Core Natural Resources, Inc. operates in an industry experiencing high demand or growth, its stock price may increase as a result of investor enthusiasm. Additionally, changes in government policies or regulations can also impact a company's stock price, particularly if they benefit the industry. Investor sentiment and market momentum are also crucial factors that influence stock prices. When investors become optimistic about a particular sector or industry, they tend to buy more shares, driving up demand and prices. Furthermore, news events such as mergers and acquisitions, partnerships, or innovative product launches can create excitement among investors, leading to increased interest in the company's stock. In conclusion, an increase in Core Natural Resources, Inc.'s stock price over the past year could be attributed to a combination of these factors, including positive earnings growth, industry trends, government policies, investor sentiment, and market momentum. Core Natural Resources, Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Core Natural Resources, Inc. trades at a higher price-to-book ratio of 1.21 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of key financial metrics and industry trends. A significant increase in eligible accounts receivable and available borrowing capacity has contributed to revenue growth, while a decrease in costs associated with the receivables financing agreement has also played a role. Coal revenues from exports have been a major contributor to revenue growth, accounting for 56% of total coal revenues in 2025 compared to 66% in 2024. Revenues from electric power producers in the U.S. have also been a significant driver of growth, increasing from 34% in 2024 to 44% in 2025. In contrast, some segments have experienced revenue decline, including workers' compensation, which saw a 1% decrease in revenue in 2025 compared to 2024. The metallurgical segment has also experienced a significant decrease in revenue from external customers. Overall, the primary drivers of revenue growth or decline are closely tied to changes in industry trends and financial metrics, with coal revenues from exports and revenues from electric power producers in the U.S. being key contributors to growth. The net income of a company underwent significant changes between 2022 and 2025. Initially, it decreased by 56% in 2023 compared to the previous year. Unfortunately, this downward trend continued, with the company experiencing a net loss in 2024. The situation did not improve in 2025, as net income continued to decline. The profit margins of the company also suffered substantially during this period. They declined from 2022 to 2023 and further deteriorated in 2024 due to the net loss incurred by the company. Although no significant change was mentioned for 2025, various factors such as revenue growth, cost reduction, or changes in business operations may have impacted profit margins. The key drivers of these changes were largely influenced by global economic conditions and volatility in commodity markets. Increased costs of commodities and capital equipment, disruptions in supply chains, and decreased multi-year sales contracts also contributed to the decline in net income and profit margins. Additionally, reduced profitability from lower coal prices, pressure to reduce prices to customers experiencing declining revenues, and impaired ability to collect payments from creditworthy customers further exacerbated the situation. Inflation resulting in higher costs and decreased profitability, currency fluctuations making coal less cost competitive in international markets, and potential overcapacity and price decline due to increased competition from foreign producers also played a significant role. Overall, these factors combined to significantly impact the company's net income and profit margins between 2022 and 2025. The company's financial performance indicates a consistent generation of positive operating cash flow. This trend is evident in various sections of the report, showcasing an increase in net cash provided by operating activities and significant amounts of operating cash flow for both current and previous years. The data from pages 82 to 121 confirms that the company has been able to generate substantial operating cash flows, exceeding $1 million in some instances. Furthermore, compliance with covenants under the revolving credit facility also supports this assertion, highlighting the company's ability to manage its finances effectively and meet its obligations. Overall, these findings suggest a strong financial position for the company, characterized by positive operating cash flow. The company's financial situation has undergone significant changes. The most notable change is the increase in long-term debt, which rose from $183,464 in 2024 to $394,822 in 2025. This substantial increase indicates a higher level of borrowing by the company. In addition to the rise in debt levels, interest expenses have also changed significantly. While there are mixed signals regarding interest expense trends, some pages suggest an increase due to higher debt levels. For instance, page 96 notes that interest expenses likely increased due to higher debt levels. Furthermore, page 123 shows a significant increase in interest expense related to finance leases from $1,079 in 2024 to $2,526 in 2025. Overall, the company's total debt and interest expenses have changed significantly, indicating a shift in its financial strategy or circumstances that warrant further investigation. The financial performance of the company varied across different segments and regions. On a positive note, the international customer base, exports of coal to seaborne markets, metallurgical coal market presence in West Virginia, thermal mines in eastern and western U.S., PAMC and Lear Complex, PRB mines, and Core Marine Terminal all performed well. However, some areas struggled. Domestic thermal markets faced challenges due to proposed legislation and regulations. Coal-producing states such as Maryland were also affected by these changes. Additionally, international markets experienced difficulties due to inflation, currency fluctuations, and geopolitical uncertainty. Foreign producers operating in countries with favorable trade policies or arrangements further complicated the situation. The industrial market, metallurgical market, electric power generation market, high CV thermal segment, and metallurgical segment all performed poorly. The PRB segment reported no revenue. Industrial applications in export markets and metallurgical applications in export markets also had uncertain performance. Management is optimistic about the company's outlook, citing its position as a leading provider of essential coal-based natural resources. They believe that the use of coal in industrial applications will continue for many years, driven by increased global power demand from artificial intelligence and data centers. The company plans to pivot its production to meet this growing demand. To achieve long-term value for stakeholders, management is focused on safe, compliant, and efficient operation, maintaining a strong balance sheet and liquidity, returning capital through share repurchases and or dividends, and allocating capital towards growth, diversification, and innovation opportunities. They are well positioned to execute their business strategies due to competitive strengths and substantial capital investment. The company aims to selectively grow its business to maximize stockholder value by capitalizing on synergies with assets and expertise, evaluating opportunities for organic growth and acquisitions, joint ventures, and other business arrangements that complement operations. Management is also exploring ways to monetize non-core assets and leasing port capacity to third parties. However, management acknowledges potential risks and uncertainties, including decreased demand, volatility in coal prices, equipment downtime, inflation, foreign currency fluctuations, compliance with regulations related to climate change and environmental standards, and financing risks. They are committed to protecting stockholders from coercive takeover tactics and vulnerable to disruptions due to force majeure events. Despite these challenges, management is confident that the company's strategy will drive long-term value for stakeholders. They plan to continue investing capital to maintain or increase production, while also exploring opportunities in critical minerals and advanced materials that leverage the company's expertise. The company has made several significant acquisitions and divestitures in recent years. On the acquisition side, the company merged with Arch on two separate occasions, once in 2025, and also integrated Arch's operations into its own business. Additionally, the company acquired assets and businesses through joint ventures and purchased the PRB segment operations as part of the merger. The company has also made several divestitures, including terminating a legacy securitization facility in 2025. Furthermore, the company may be forced to sell material assets or operations if it is unable to meet its debt service obligations. The sale of certain energy-related assets is also being considered due to increased risk of terrorist or cyber attacks. In terms of specific divestitures, the company has sold assets restricted by senior secured credit agreements and Series 2025 bonds indentures. These transactions are a result of the company's efforts to manage its debt and meet its financial obligations. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out quarterly amounts, totaling $20,870 over the specified period. This demonstrates a commitment to returning value to investors. In addition to dividend payments, the company has also engaged in share buybacks, repurchasing 3,088,520 shares at an average price of $72.61 per share. This strategic move not only boosts shareholder equity, but also reduces the number of outstanding shares, potentially increasing earnings per share and benefiting long-term investors. That concludes the financial summary for Core Natural Resources, Inc. Feel free to comment below, and I will be happy to answer them when possible.